everyone, welcome to our channel where we help your real estate investments work harder for you. I'm Samantha from Elevate Realty in Toronto. The ultimate goal of investing is to maximize your returns while minimizing risk. So if something has similar risk and higher returns, then it's usually a no-brainer to go with that option. Something that you might forget to take into account are transaction costs. Now, if you're trading with stocks, you probably don't need to worry as much about this since transaction fees, especially with online trading platforms, are low, but real estate investing does come with higher transaction costs, so you definitely need to take this into account. If you have enough capital, ideally you would put some money in stocks and some money in real estate to diversify your portfolio with different investment timeframe objectives. In this video, I'll explain what situation real estate investments are great for and when it might make more sense to go with something else. Before I dive in, remember to subscribe and hit the notification bell so you don't miss other real estate investing videos like this from our Elevate team. Here's a chart from Thomson Reuters that illustrates the risk and return of different types of investments. As you can see, government bonds have the lowest risk and also the lowest returns, and stocks have higher risk and higher returns. What's interesting here is that real estate has higher returns compared to stocks and also lower risk. So if you had to make an investment decision based on this chart alone, real estate would be the best choice out of everything. This chart doesn't take into account transaction fees. This is a fixed fee, whereas your returns keep growing year over year. So if you hold real estate for a longer period of time, the transaction fees will become smaller in comparison to your bigger pool of total returns, so the impact is less significant. At the same time, even if your rate of return for real estate is good, your absolute return isn't as much when you're holding it for a short period of time. So in this case, it's possible that transaction fees might wipe out your returns. Now, let's dig a bit deeper to see how Toronto real estate specifically stacks against the S&P 500 index. From what we've seen so far this year, it's pretty obvious that stocks are a lot more volatile compared to Toronto real estate, but here's more proof. This is a chart that compares the annual growth of Toronto real estate compared to the S&P 500 index over the past 20 years. Toronto real estate has had much softer swings compared to stocks, and the standard deviation for Toronto real estate is 0.04 and the S&P 500 index is 0.13. If you're not familiar with the statistical term, basically a higher number represents higher volatility. Now, when we invest in real estate, we're most likely buying with a mortgage. If we're only paying 20% down but getting the impact from all of the property's appreciation and depreciation, then our gains and risks are increased fivefold. On top of this 20%, we'll also need to add an additional capital for things like land transfer taxes and legal fees, which total around 4% of the property's purchase price. We'll also add in some renovations that cost around 6% of the property's purchase price. So in this example, let's say we put in 30% of the property's price as capital, which means we're levered a bit more than 3 times. The next chart shows how real estate after leverage from our example compares to stocks. As you can see, the risk is now more similar with a standard deviation of 0.15 for real estate after leverage, and again 0.13 for stocks. You can also see that even at a similar risk level, the average returns on real estate after leverage are a lot better than stocks. But like what I mentioned before, real estate has high selling costs. So how would this risk return curve change once we take that into account? So here's another example to give you my answer. Let's assume you have $250,000 to invest in. With this amount, you can buy a property that costs $850,000 with a 20% down payment. You'll also add in $50,000 of renovations. With closing costs, this totals $250,000. In year 1, you get rental income, which builds equity of $17,000, and you generate $6,000 in extra cash flows. On top of this, let's use 5% appreciation, which totals $47,500. Because real estate is more work for you than stocks, you value the time you put into managing your property at $5,000 a year, which brings your total returns to $65,500. Selling costs are $54,000, closing costs were $30,000, so you actually lose money if you sell in year 1. With a similar amount of risk, you can actually invest in stocks, and because there are higher price fluctuations in stocks, you're able to get 7% returns on $250,000, which gives you $17,500 in net returns. So at a similar amount of risk, investing in stocks win if your investment time frame is 1 year. In year 2, you make more money with real estate. The total cumulative returns now is doubled with quick math at $131,000. If you sell this year, you deduct selling and closing costs again, leaving you with a total return of $47,000. Stocks give you another 7% or a cumulative gain of $35,000. In this case, real estate starts getting better, but you also have to deal with reviewing more legal work and accounting work, so I'd say this is kind of like the break-even point. You can repeat this process for the next few years, which I did, and here's a summary that compares the total returns after you take into account real estate transaction fees. Just as an FYI, I also take into account inflation and rent increases for more accurate calculations in this chart. Starting year 3, it starts getting obviously better with total real estate returns being $115,000 compared to stocks at $56,000. So basically, instead of just looking at risk and reward, you should also look at your investment period. In this example, at the same level of risk, stocks perform better under 2 years, whereas real estate investments with leverage start becoming a star performer after 2 years. Now, everyone's real estate investment goals are different. If you're retiring, you might be more interested in preserving your wealth instead of growing it, and liquidity is more important to you. In this case, real estate might not be right for you, and it's better to go with more low-risk investments combined with higher liquidity and lower transaction costs. If you're considering flipping a house or trying to take profit from real estate over a short period of time, remember to take into account fixed fees and also keep in mind that short-term real estate investing gains might even be charged as income tax instead of capital gains tax, which is double the amount. If you're in the process of growing your money and you don't need access to it for at least say 2 to 3 years, then that's when you should really consider a long-term real estate investment, which can significantly improve the performance of your overall portfolio in the long run. And finally, if you want to learn more about real estate investment opportunities in Toronto, we're here to help. You can contact us with a link that I'll put in the description below. And if you find this video useful, please give us a thumbs up and help us out by sharing it on your social media and tag us at Elevate Realty CA. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.